This content reflects my own personal opinions and is not financial advice. With that said, let's kick off today's episode. Tokenized money is scaling fast, with CBDC pilots exhilarating, stablecoins stacking up, and Japan preparing a tokenized yen for its 120 million users. Securitize is already bridging US EU securities into regulated markets. The foundation of programmable finance is here. But who's laying the rails of tokenized finance today? Okay, so this is one of the first announcements. A central bank in the UAE are actually exhilarating their CBDC pilot. Now, this is a concern because there's a lot of central banks that are trying to weave its sphere of influence over the global stablecoin market, which is growing into the billions, right? The current TVL for the stablecoin market is around 300 billion US dollars to date, and it's poised to reach its first $1 trillion. So the central banks who are considering piloting their CBDC digital currency on their blockchain sees this as a threat. Now, if you look into this other global tracker on the current state of the rollout of the CBDCs by jurisdictions and nation states, you can see overwhelmingly over half of the countries have abandoned the CBDC initiative and just simply resorted to stablecoins, which is, I insist, that is the trend that we are seeing. Whereas the other half of the world, nations, are still piloting, but like I said, it's to no avail because it's a 300 billion global stablecoin market and is going to be set to reach its first trillion, whereas the CBDCs are nowhere near the stablecoin market. So for that reason alone, I'm not concerned. Even though the UAE have taken this decision, which is legitimate in their own interest, what I'm trying to say as a warning to investors is to use the actual stablecoins for the day-to-day rather than using any nation state's own CBDC currency. That's really what I'm trying to get at here. So I'm not overly concerned by this. Now, if I move on to the next article and product offering by JPMorgan, because it's using BlackRock's IBIT, its original Bitcoin spot ETF. Now, we know that is the largest in US ETF history, right? It has, I think, well over $100 billion of accumulative ETF inflows for the Bitcoin spot ETF. So it's rather significant and is using that as leverage or guarantor for their own structured commercial notes offering on top of the IBIT, which gives it credibility and an interesting set of returns, right? So this is very interesting because we're starting to see that the Bitcoin ecosystem, even though it's $2 trillion at the moment in total value locked into the network, we are starting to see layers of additional financial products on top of the Bitcoin based layer. And why is that? It's because the actual Bitcoin holders, where they're unable to generate any yield as a result of holding on to their Bitcoins directly. In no way I would advise that you'd relinquish or sell any of your Bitcoin holdings to purchase into these structured product offerings. But nevertheless, having said this, if you're keen on generating yield whilst you're still holding on to your Bitcoin holdings, then this certainly would be something that you should investigate and look into. Now, if we move on to this other article on other nation states outside the US, in the case of the UK has released new guidelines requiring crypto exchanges to provide the tax authority with full customer information on digital assets. Starting in January next year, 2026, this enforcement marks a significant step in tightening oversight of crypto activity and signals the government's intent to close gaps in tax reporting. Again, this is something that is not new. The crypto exchange platforms in Europe are already reporting the crypto transactions to the local national tax authorities. It just so happens that the UK is playing catch up and just aligning their same crypto tax reporting rules with that of Europe, with their neighbour. So in the case of Spain, there is an exception there in the sense that what happens if the rest of the customers have their holdings under self-custody to which they themselves have complete control in terms of their private keys accessing their self-custody crypto? Well, that is not needed to be declared to the taxman, at least in the eyes of the Spanish tax authority, and that is as of today. But I just thought just to mention that because there are some subtleties in terms of the full extent and disclosure requirements around crypto tax reporting. But if you're in doubt in the jurisdiction that you live, you need to always resort to your own financial tax accountants who are best placed to give you the up-to-date crypto tax rules and reporting if you need to do some digging and research of your own. Right, moving on to another interesting article. Australia's new digital asset bill prioritises custody, licensing and operational safety, core requirements for institutional tokenized markets. By raising platform standards, the bill clears the path now for compliant issuance of digital bonds, funds and institutional RWA instruments. So it's good to see that Australia is aligning themselves with how the rest of the forward nations out there in laying out the clearer pathways to governance and regulation on digital assets. And this is very, very positive. This makes sense because if nations don't raise their game and accept that crypto, digital assets and Bitcoin are here to stay rather than acting in haste, which has been the case in other jurisdictions. But we're starting to see that the tide is changing to one of overwhelming support now on the advances of crypto as an industry and as a growth engine that is fit for the 21st century digital economy. So very good news. And on the same note is this next article here around Securitize securing an EU license is a defining milestone enabling compliant cross-border distribution of tokenized securities between the United States and Europe. This establishes the first regulated bridge for global RWA liquidity, allowing institutions to issue, trade and custody digital assets across major financial regions. Again, anything that helps towards supporting the development of digital assets, crypto, Bitcoin across all jurisdictions can only be a good thing, because with that, you're going to be bringing in liquidity and innovation, which are the core ingredients that is required to make this industry grow and prosper. If I move over to the Far East, it says here that Japan Post-Bank's plan to deploy a tokenized yen for 120 million customers creates one of the world's largest programmable money ecosystems. This provides instant settlement rails for future tokenized bonds, real estate and savings products, making Japan a major RWA hub in the region. So again, this is very, very positive. We'd like to see other parts of the world, not just the US and Europe, but indeed further overseas, to follow suit, right? Because what's working in one part of the world should be replicate and copy into other areas. And this is what Japan has done through this announcement. And then this leads to my final article in South America, where it says that Bolivia, formally integrating stablecoins into its banking system, shows emerging markets leapfrogging traditional infrastructure in favor of tokenized money rails. This enables faster payments, financial exchange stability, and smoother access to RWA-backed savings products. Again, stablecoins, stablecoins, stablecoins. That for me is how I would sum up this week's midweek's review. So in closing, from CBDCs to stablecoins, from treasuries to regulation, the rails of programmable finance are being built at scale. RWAs are becoming the backbone of global settlement. The only question left, who takes the lead in shaping the future of money? That's all I have for you for today. If you value clarity on Bitcoin, blockchain technology, and real-world assets tokenization, stay alert. Subscribe and enable all notifications to stay ahead of the curve. Share this episode with those who need to understand what's coming, friends, family, and colleagues. This channel aims to deliver insight, no noise, and no hype. Subscribe now.